This is regulatory arbitrage in action. Financial services gravitating toward the least regulated channels. The answer lies in what happened after regulators tightened the rules on traditional banks. After the financial crisis, the regulatory landscape for banks changed dramatically. Capital requirements increased, stress tests became routine, and oversight intensified. These reforms were meant to make banks safer, but they also made traditional lending less profitable and more cumbersome. As a result, many financial activities migrated to institutions that weren't subject to the same constraints. This is regulatory arbitrage in action. Financial services gravitating toward the least regulated channels. The impact is clear in the growth rates reported by the Financial Stability Board. A narrow measure of shadow banking, focused on activities that most closely mimic traditional banking and carry similar risks, grew by 11.1% in 2019. Outpacing the 7.1% average annual growth seen between 2013 and 2018. This shift wasn't gradual or accidental. It was a direct response to the tighter regulatory perimeter around banks, which pushed credit creation and risk-taking into less supervised corners of the financial system. Private credit stands out as a particularly fast-growing segment. The OECD estimates the global private credit market at just over $2 trillion as of April 2024. Amounting to roughly 12% of all bank loans to non-financial corporations. Non-bank lenders have increasingly stepped in to provide financing to businesses that no longer fit within banks' tighter lending standards. This trend has accelerated since the crisis, as investors searching for higher yields poured capital into private lending funds and direct lending vehicles. Official data shows that assets managed by other investment funds, many of which focus on private credit, grew at an average annual rate of 11% between 2013 and 2019. The relationship between banks and shadow banks has also evolved. While banks once dominated corporate lending, they now often act as financiers to non-bank lenders, supplying the funding that allows these firms to expand. This creates a web of interconnections where stress in one part of the system can quickly transmit elsewhere. If corporate borrowers struggle to repay, the resulting liquidity pressure can move from non-bank lenders back to the banks that fund them, amplifying systemic risk rather than diversifying it. The expansion of shadow banking is rooted in the search for regulatory gaps. As rules tighten in one part of the system, activity flows to where oversight is lighter and constraints are fewer. This has made the financial system larger, more interconnected, and more opaque. But the real test comes when stress hits, because the way shadow banks are structured leaves them uniquely exposed to sudden shocks. This fragility is built into the core of shadow banking.